Alrighty, we're going to look at yield and price earning ratio in this section, and these are two indicators that tell us how well our shares are going, or whether it's good to buy or sell shares. So they're two really nice little indicators that you can use. They're in the newspaper on the share list, and it helps give you a bit more information about what's going on with the shares. So let's have a look at a bit of a discussion on what the yield and stuff is. So the yield, whoopsie daisy, the yield looks at your amount of money you get back for investing. Okay, so the higher the yield, the better the investment, and the yield is shown in a percentage. Now there are two ways you can do it. You've got a formula that goes yield equals annual income divided by total cost times by 100, or the yield equals dividend per share divided by the current share price times by 100. So once again, converting them both into percentages. The first one is more accurate, the second one is approximate. Okay, so what we need to do is we need to look at what the question tells us and what it's asking us, and to see which way we go. But basically you're trying to see how much money you're getting back in a dividend when you invest in these shares, when you look at the price. So let's have a look at how this works in the question. So you've got to read the question first and look at the information you've got. And generally, if the question says along the lines of exactly tell me how much it is, you've got to do the full buying thing, work out how much money you've got from your dividends, and away you go. If it just says approximate, it's really easy, and that's what you can use in the share list, but we'll get to that in the second part. Okay, so let's have a look at an example. This is the longer way. You purchase some 500 ATY shares at $1.29 each, with a 2.5% brokerage and 10% GST. The company pays a dividend of 5 cents per share. Calculate the yield. So we've got to buy them first, and then after we buy them, we've got to be able to then work out the yield by looking at how much money we make. So when we do this is what we've done before. We get 645. When we times that by 2.5%, you get $16.13, and that gives you $1.61. Is your GST there. When you add them all up, it's 662.74. Now your yield equals your annual Inc. total cost times by 100. Okay. Now your annual income is how much money you make from the shares, and that comes in your dividend. So if you have your number of shares times by your div per share. Okay, dividend is just a division of the profit, and it's expressed in cents per share. So if you own 10 shares and it's 1 cent per share, you get 10 cents. So in this case, the number of shares that we own are 500. Dividend per share is 5 cents. So therefore our annual income is going to be 500 times 0.5, which is $75. Okay, so now your yield equals an Inc. over total cost times by 100. We've now got our annual income, which is 75. Our total cost is what we worked out from up here, 662.74, and times by 100 gives you a grand total of 3.77% as a yield. Now that's not a bad yield, that's 3.7%. If that's higher than the banks, you're going really well. If it's lower than the banks, then maybe your investment isn't actually returning as well as what it should be. So let's have a look at the shorter way, which is when you're just given 2 bits of information. So you have BFA shares that trading at $5.28 each. You get a dividend of 20 cents per share. What approximate yield is this? Now, using the approximate yield, it is same kind of formula, same kind of thing. It's the yield equals your div per share over your market value times by 100. Okay, so it's a short version. So our yield, div per share, you've got to make it sure it's in a decimal like that. Market value is $5.28 times by 100. And when you solve all that out, you end up with 3.787, which would be 3.79%. That's an approximate yield because it doesn't take into account the costs and fees and charges when you actually buy the shares, but that's pretty good, so I can tell you what that is. Now, if you want to work it around the other way, make out you've got a question where you've got the yield as a percentage, but you don't know what the div per share is. So what we do is we do a bit of a rearrangement. So let's have a look. We've got at the moment we've got yield. Whoops. Let's go back. We've got our yield equals the div per share divided by market value times by 100. So what we want to do is we want to rearrange it. So if we've got our market value and our yield, we're trying to find this. So our div per share is going to equal your market value times by the yield. Okay. Now this yield will be as a percentage. Okay. So let's have a look at this kind of solution there. So what we'd have is we'd have div per share equals $4.98 because they're trading at $4.98. Our yield is 0.07, so we've just rearranged the formula and we get 0.3486. So it's about, which means 35 cents per share. Now sometimes they will go to one decimal place in the calculations, but 35 cents per share will probably get you through that. So that's the yield part of it. So that tells you your returns or what you're getting on it, as long as you're getting paid a dividend. If you're not getting paid a dividend, this doesn't help you at all. So that's where price earnings ratio comes into it. The price earnings ratio basically tells you how long it's going to take you to pay your shares back. Looking at how much they're gaining and how much the company's earning. So it's not a bad little way of measuring what's going on, and these are good for mining companies because they normally don't pay a dividend. So if a price earning ratio is 14, then it's going to take you 14 years in earnings to cover the share price. Okay, so it gives you a really good understanding of a stock's relative value and can tell you whether it's overpriced or underpriced. And there's a couple of other things attached to that as well. So basically you divide the share price by the earnings per share, and the earnings per share is worked out by how much money they make divided by the number of ordinary shares they have. So it's a good indicator, and it's worked out by market price per share divided by your earnings per share. And if you want to work out your earnings per share, you get your net profit for the ordinary shares divided by the number of ordinary shares. Now this all sounds a bit gobbledygookish, but we'll work out how it goes. The price earnings ratio is really, if it's really stable and not moving much, then it's going to be quite low. If it looks like there's going to be a speculative bubble, or they're going to be bought out or something like that, and it gets bigger and bigger, then the price earnings ratio might move upwards, but it might become overpriced. So you can't, once again, you can't only just look at one thing to tell you whether to buy or sell, but it gives you an idea about what's happening with the market. So let's have a look at a table which tells us what's happening. So the price earnings ratio in this table here shows us kind of what we're looking for. A value between 0 and 10 means that it's probably undervalued. Okay, it's not going that well. Between 10 and 20, it looks like good value. 20 to 30, it either means that it's really overvalued or the earnings have decreased. And the last one is 30 or higher, means that it's either got exceptionally good growth prospect and people are trying to get into it and it's looking really good, or and it's the subject of this positive speculation, so they're about to find some more oil or something like that and suddenly the price goes up. But once again, you've got to look at the whole market, what's going on before you make that decision. So market conditions will have a strong influence on the price earnings ratios, but it does give you a snapshot of what's happening. Okay, so let's have a look at a question to see how it goes. Suncorp has a profit of $720,000 and has 120,000 ordinary shares. What's the price earnings ratio if the shares are currently trading at $42? So let's look at the earnings per share. So whoopsie daisy, the earnings per share are going to be like this. Earnings per share equals your profit, number of shares. So our profit is $720,000. We have 120,000 ordinary shares. So our earning per share is $6. Okay. So then our price earning ratio is the market value divided by your earnings per share. So our market value in this case is $42, which is what they're trading at, divided by 6 means that we have a price earnings ratio of 7. So the PE ratio equals 7. And now if you want to talk about whether that's good value, you go back to your table and have a quick squiz. And the table says between 0 and 10, it's either undervalued or it's been predicted to decline. So this could be, and that's where you've got to look at what's going on in the market as well. So this could be undervalued or on the way down. So it's just an indicator. Remember, we're talking about indicators here. So when you look at the yield and the price earnings ratio together, you can work out whether your shares are good value.